dive into the charts and get technical here. I want to go straight into it. Frank Cappelleri is joining us back here on the program with a bunch of technicals to walk through here. Frank, good to have you back as the Executive Director at Instinet LLC. Frank, let's just go to the S&P 500 first, because I love your first chart. It looks a lot like the one I've been harping on here, which is that our big sell-off just kind of brings us back to an area that had been pretty important before.
Oliver, thanks for having me. That's right. And if you look at this from a long-term point of view, there was that breakout that we recently had in May, right near 2950, and that produced a very big breakout target above the highs earlier this year. And you can see how that played out, because it was just a culmination of successful bullish patterns along the way, and really that has been what's working. As we know, flipped, and at that point, the trend really took over, and it brings up a very interesting scenario now, clearly because of the shock from last Thursday, but that really just turned the last few weeks of action into a potential, topping pattern. Again, something we haven't seen in over 2 or 3 months. And so I think at that point, if you look at that topping pattern, that can have a target down below the previous breakout points. There's a lot of things going on here, but whether you're looking at the S&P 500 or a host of the ETFs, stocks, what have you, they all have similar looking patterns because of that.
Yes.
And I think that's why a lot of those areas, like the value spots especially, came right back down. And I think, it's really a put up or shut up time at this point for them, because seeing some demand come into those areas really helped the market get propelled over the last few weeks.
I think I heard a put up or shut up time in there, Frank, and I'm with you, because there's a lot lining up that looks like we're testing either trends on some of the cyclical areas of the market where we're uptrending. Now we're kind of testing that trend, and for the S&P, we're testing the top half of that range that roughly, you could put a line at maybe mid 2700s on the downside, 28 maybe. What to you is kind of the next stop if we go into that range below 2950? Does that mean we test that horizontal range that we were in?
Possible. I go by patterns and the targets measured from those patterns. And so the current one, if we do have a close below 3,000, targets the 2765 area.
Okay.
So that would take out 2950, but if you take a step back and look at this, from a even longer term point of view, the market's built up huge cushion now, right? It can absorb something like this. It can absorb a good amount. It just may not play out as we're used to in terms of a straight shot down, a shock, and a 7% decline followed by a 6, so forth and so on. So best case scenario in terms of healthy price action, we have this huge snapback rally, comes back down, then settles in. And then you can see an even bigger base form from that point. So, we want to get all excited about how things break and how trends can completely shift like they have over the last number of months, but, we could be into another type of market environment now for the breaks on both sides of these huge moves.
Okay, so now we've got a pretty good area here that we can test. We haven't broken it yet. Frank, if we look at the topping pattern possibly that's forming, we're seeing that kind of island up there of action beyond 3,100. What to you says that it is indeed a real serious top we need to look at? How much breakdown then says, okay, that was a temporary top?
Right, so that would be the 2765 area. And then from there, it gets very important to see how the bounces work, right? So, I'll look at a few different indicators, but the most important thing I think is that in a bearish environment where you have bearish patterns working, but you also have a continuation of lower highs that turn into other bearish patterns. And we saw this in a very accelerated fashion, of course, in February to March, but the same type of pattern played out. So again, are we going to see a complete reversal of that happen again, another waterfall decline? It's possible, but I think it would be very hard to imagine the same exact 35-40% decline in 5 weeks, which was due to a multitude of reasons, and the uncertainty level was clearly much more severe back then.
Okay, so the potential for this to turn ugly is real, no doubt about it. Frank, when you look at the VIX, though, it almost kind of looks like this was bound to happen. I like this chart you have. It's a pretty simple one. It's just the VIX with some moving averages in the longer term 200-day moving average, I mean, we just hit it perfectly. It's like a trampoline.
Right, and I think even more interesting is the fact that the support level that it rallied from, which was right on that 200-day, which you mentioned, was the high from 2019. To give you an idea, obviously, how drastically different it is now. And so with that, as long as it stays elevated historically, I think we have to, be prepared for some bigger moves here and there where you could still have the market eventually working higher, but not be surprised to see some of the moves like we saw last week. So, best case scenario in terms of healthy trends we've been used to over the last few years, we're used to VIX below 20, even in the teens. That, makes for a very, boring and typical market environment, but that's the type of, healthy trends that we've been used to. So I think we have a while to go before that happens. At the same time, you still obviously would like to see the VIX a little bit lower to help the market's case.
This is not a clear-cut path lower for VIX. I mean, we generally think about it as this mean reverting asset, as a basically a zero reverting asset. It comes back down. It's got a floor, but from a technical perspective, what does it mean that that floor is kind of shifting higher? It seems where we're bouncing off these moving averages, VIX in a totally different realm, and we haven't had a single-digit read since before this whole thing began.
Right, exactly. Just continuing with the points we were just talking about, is it's elevated for a reason, where you're going to have moves that are larger than we're used to, and we've seen that on both sides of the tape, really. And you think about how, if someone mentioned that the market was up over 40% in 5 weeks and the VIX was still above 20, if someone mentioned that last year, you wouldn't believe it. It's all about where we come from. It's all relative. So, you saw these started to move a little bit, right? The VIX started to bottom a little bit before the S&P topped both times, and I think that's something to look for going forward as well.
All right. Frank, let's talk some sectors here. As you mentioned, there's a lot of charts that are testing trends. They're testing important levels, I think, on the cyclical side and part of the reopening trade. Let's hone in on financials. The chart that you've got in your note from this morning, I think, speaks to this, where it kind of looks like that S&P chart from the top of our conversation, except kind of on its side, because for banks, they had been trending higher. And now, are we testing that trend?
Yes, we're testing that breakout point that we had 2 weeks ago, which is really important because the XLF in particular had a very hard time pushing through resistance levels that, say, technology and healthcare did in the first few weeks of the rally. And so, it took a lot. It took the yield finally just moving up just a little bit. But when the value trade worked, right, with energy, industrials, and finally financials, that's when you saw, obviously, value work. But I think more importantly, it helped those previously diverging vast decline lines start to confirm and obviously get close to making new highs. And I think at that point, even though we heard a lot about, the retail loved names doing so well, and it was all because of that, I think it was more important to see the participation broaden out more than just having technology and healthcare, what have you, lead us. So I think seeing some support near a very important breakout point for the financials, and you can even take that, of course, drill that down further, especially the banks, I think is important for the nature of supporting this move more than just a quick rally.
So for banks, it's kind of choppy in the rally up to begin with, right? I mean, it's kind of a stop-start. Should we then look at that and say, okay, maybe this is just kind of a bigger stop after a huge start? I mean, we have to kind of take into account this high beta nature. How do you, as a technician, determine what is a real threat of the trend versus just a really wide swing?
Right, and I think we have to redefine those these days as well. It's because, the move from the low into the XLF was very expensive, but it really got much beyond that breakout point in a too quick of a manner that actually anticipated holding. So at this point, you had the spike, you had the crash, or mini crash, if you will, last week, and now I think you're going to see demand from a higher point. So we talk about higher lows lot, but this is the reason why, where it'll sometimes take a little bit longer for these areas that were lagging maybe to come back into the picture in a major way. But one thing we were talking about, say a few weeks ago when technology was taking off, it was like you can't have, even the biggest areas, you can't have moving one way while so many others that are important to the economy move the complete opposite, right? Mm-hmm. And so that's what we want to see. You want to see as many go along for the ride, knowing that some will lead and some will just have to play catch up.
Frank, just real quickly, before you go, I want to assess the gold versus stocks chart that you had this morning. It looks like the takeaway here is a potential for gold to pick up steam again if stocks break down.
Right, or even just having gold start to do something again. If you look at that chart, it really has not done anything, right, for the past 2 or 3 months as the S&P has taken off. And you could look at gold versus the S&P for almost 2 years, right when it bottomed in August 2018, it consistently outperformed along the way. It hasn't been straight shot higher, but we've seen, again, the higher lows on a relative basis. And even because of the stock, the equity is doing so well and gold doing nothing for the last few months, that relative strength has come in. And I think if the trend continues to hold, you may see the short-term inflection point where gold and those areas start to do a little bit better than equities for a little bit.
Yeah. All right. A trend changing here over the last couple months for stocks, but gold hanging on. Sure as heck is hanging on. Frank, nice work on the charts as always. Really like the technical perspective. Frank Cappelleri joining us from Instinet.